You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with myself, John McEwen, and my co-host, Sam Ball. This week on The Investor Way, we have Redrow, Ocado, Dunelm, Coca Cola HBC, Heineken, and Disney. What should we start with, Sam?
Should we start with Redrow, John?
Okay, Redrow. So Redrow, as if you don't already know, is a UK house builder. It's got a market cap of just under 2 billion, and it's released its half-year results. The highlights were the revenue of 1.04 billion, which is up 20% from 870 million in the previous year. Completions increasing from 2,554 to 3,065. Gross margin at 21.3%. Full year operating margin of approximately 15.5%. First half year profit up 11% at 174 million from 157 million. Earnings per share up 10% to 41p a share. Dividends reinstated with an interim dividend of 6p a share announced and a net cash position of 238 million. The chief executive, Matthew Pratt, said, "We have seen a strong sales market during the first half, driven by a combination of pent-up demand from the first national lockdown, the introduction of a stamp duty holiday, and the impending end of the Help to Buy scheme for existing homeowners." At the end of December 2020, the group had a net cash position of 238 million, compared to a net debt position of 126 million at the end of June 2020, as we converted our high level of forward work in progress into completions. Given the group's cash position and order book, the board has resumed dividend payments with an interim dividend of 6p. The group is processing a sizable pipeline of sites with terms agreed, and we therefore expect acquisitions to accelerate in the second half. Sam, what do you think of these results?
I thought they were impressive. So last time we spoke, so these are the half year results to December 2020. Last time we covered it, it was the full year results to June 2020. And when we covered it last time, revenue was down 37%, profit before tax 66%, earnings per share 64%. However, they did have this record order book, which they've obviously maintained. And if you look at what they've done in the 6 months since, they're pretty much back to normal. I mean, the figures they're putting out, they were quite similar to the 2018 figures and the 2019 figures, which were the last couple of normal years they've had. Earnings per share is in line with those years. And they've done that whilst maintaining the order book, which, as you mentioned, is still 1.3 billion. So I think to maintain that record order book whilst returning to prior levels, I think it's a really impressive performance from them.
No, that's right. Likewise. And I think over the last 6 months, you do see that reflected in the share price too. The shares are up nearly 30% over the last 6 months. So the market generally would seem to agree with that view. And in terms of valuation, the price to earnings is hovering around the 15 mark.
Yeah, it is. Yeah. So I worked out there for the trailing, if you take the trailing 12 months, price to earnings is 15.4. But if you look at, say, I took 2018, and if you use that as normalized earnings, just I thought the half was slightly more similar to that year than the 2019 year, you actually get a PE of about 6.6. So on a normalized basis, it doesn't look outrageous. And the 2019 year was actually better than 2018. So if they can get back to that level, that PE could actually be more like 5 or 6. So yeah, so I like the business. I like the results. The only blemish I was able to find was the CEO had given a current trading outlook, and he did mention that in the 6 weeks to 5 February, private reservations in terms of value have averaged 265,000 per outlet per week, and that compares to 298,000 in 2020. He said this is below a very strong comparable last year, and is also being affected by reduced availability of product created by the strong forward sales position. The private sales rate, however, of 0.67 per outlet per week compared to 0.78 in 2020 is, however, in line with our long-term expectations of trading within a more normal market. But they were fantastic results, I thought.
Yeah. And I think the shares on the day were down a couple of percent. So perhaps there was an expectation that they might be even better. But overall, I thought it was a good set.
I think, yeah, and like I said earlier, I think it's not so much the results, it's the results whilst maintaining the size of the order book.
Mm-hmm. Yeah, sure.
So should we move on to our next company then, John?
Yeah, so next, do you want to go on to Ocado? Should we discuss Ocado?
Favorite of the show.
Yes. Understand it better now than at the beginning.
Ocado have come out with their full year results to 29th of November 2020. Last time we covered them on the show, they had announced their retail revenue was up 52%. Their average number of orders per week were at 345,000. The average order size was £141, and the full year expected EBITDA was £60 million. However, we did have issues with this metric because the EBITDA, which is earnings before interest, tax, depreciation, and amortization, seems like a very poor metric to use for a company like Ocado, just because of what they're doing. It's so much like robotics and building stuff that you'd expect depreciation and amortization expenses to be quite high, and those are very real expenses for a business like Ocado. So it's the metric that management like to use because it gives them a profit, but it's not really the metric that we think they should be using. But anyway, get into the results. So for the full year, their revenue rose 32.7% to 2.3 billion. And that mostly reflected a 35.3% rise in retail, which is 50% owned by M&S, and a 13.6% increase in the UK solutions and logistics business. The group EBITDA rose 68.8% to 73.1 million, which was actually slightly higher than their expectations. They said they were expecting about 60 million last time we talked about them on the show. However, this was driven by retail, and the solutions business was less profitable than the analysts had predicted. The group said it expects to spend 700 million on capital expenditure in 2021 relating to the development of customer fulfillment centres. This is some way above the market's expectations. For the retail figures, there was a £31 increase in the average basket size to £137. Revenue was 2.2 billion, which was just over 35% higher than last year, with the increase supported by increased capacity. Some marketing was paused, and that meant the number of active customers fell to 680,000 from 795,000. I do think it's worth mentioning that I thought it was quite concerning that if they pause marketing, they get that higher drop off in active customers, because that shows they've got very high churn. They said despite higher costs, including COVID-19 related expenses, the cash profits, which is what they call the EBITDA, more than doubled to 148.5 million. A 10.6% increase in fee revenue meant the UK solutions and logistics revenue rose 13.6% to 654.3 million overall. Distribution and administrative costs increased, the latter mostly relating to headcount and technology spending. And that meant cash profits fell to 44.4 million from 72.1 million. Profits were also held back by reduced fee income from Morrisons after the agreement to take back capacity following the Andover fire. International Solutions saw a 52.2% increase in fees invoiced, reaching 123.9 million, and revenue for the division rose to 16.6 million. But this was helped by the sale of some equipment to a retail partner. There was a 67.7% rise in distribution and administrative costs, which meant the cash losses widened to 83.3 million from 54.9 million. Ocado spent 190.6 million on developing international fulfillment centres, almost tripling from last year, and over half of the spend relates to North America. Ocado has received insurance payments of 103.9 million relating to the Andover fire, and the group is negotiating further claims and expects more payments relating to reconstruction and business interruption losses. The group said it's mitigated most of the potential supply chain risks relating to Brexit, but it's unable to do so for a number of fresh goods. Despite the higher profits, there was a £119.2 million free cash outflow during the year, relating higher capital expenditure, which I think does hammer home the point that the depreciation and amortization is a very real expense. Net cash, including lease obligations, was 671 million at the end of November 2020. They've said for 2021, they expect double-digit percentage revenue growth in the UK solutions and logistics, and invoiced fees for international solutions to rise 30%. Guidance wasn't given for retail given uncertainty surrounding COVID-19. In terms of valuation, they're trading at a price to sales ratio of 6.2. That compares to a 10-year average of 2.3. They are currently trading at a market cap of 19.62 billion. Thoughts on Ocado, John?
It certainly seems to have quite a heady valuation, and often, well, so far it doesn't seem to really meet its figures. There are other concerns, like I think there's a patent battle that's going on with AutoStore, which is a Norwegian rival. So I think they've got quite a lot of expenses or outlay associated with that. And I think you picked up on a good point about the sort of high amount of churn that they had when the advertising stopped. So some of those, I think, are probably red flags or amber flags, if you want to say that, about the business. I'm probably a bit more bearish on Ocado. I know it's the share price has performed well. It's outperformed the FTSE 100.
So it's up 116% over 1 year, 176% over 2 years, 455% over 3 years, and 1,002% over 5 years.
Okay, so I suppose, despite being bearish about it, the share price at least has really been smashing it. But yeah, I don't know. Probably have some ongoing reservations. How do you feel about the results?
They were decent. The growth was 35% or whatever, 37%. It's decent growth, but the problem they've got is they can only grow so much because it's so capital intensive. So they have to build out the infrastructure to be able to grow. And the issues I've got is the churn is concerning. Just the way they measure the business is also concerning. They talk about cash profits, and what they're doing is they're excluding the capital expenditure, and they're not talking about depreciation and amortization, but every year they're going to have very high capital expenditure. And it is a very real expense, and it's an expense that they have to pay for it all up front, and then they only get the expense over a number of years in the accounts. So to just remove that, I don't think it's a fair reflection of the actual business, because for some businesses it does make sense, but for them it's a very, very real expense, and we see that where they're spending so much on capital expenditure each year. So to just measure it without the depreciation and amortization in there, I think is extremely misleading. Yeah. Unless they get to a point where they say we're not going to have to spend anything on capital expenditure anymore. And I don't think it's that kind of business. I think the price to sales is very expensive, especially given that they are in a very capital intensive and what I think will be a low margin business. I struggle to see a scenario where they get to a level of profitability to justify the valuation. That being said, the business is performing well. They are growing as much as they can, given the capital expenditure constraints. They've got more demand than supply, which is a good problem to have. And I recently watched a video of one of the warehouses with all the robots moving around, and it is an extremely impressive product. And I can see why other companies are wanting to pay for them to go and build the warehouses for them and stuff. But yeah, there's too many question marks, and I think the valuation is absurd. But I'm trying to give the company credit, because the valuation is not the company's fault. They can't do anything about that. Yeah. And they are delivering as much as you'd expect them to, given the capital constraints. I just don't know why you would pay 19.62 billion for this business. Right. We say this every time, and the share price continues to go up.
That's it. Okay, so next we've got Dunelm. Dunelm, mostly a homewares business. They've come out with the interim results for the 26 weeks ended 26th of December 2020, and it's been a strong performance. The highlights: very strong sales growth of 23%, and that's despite the impact of store closures in the second quarter. Continued market share growth, with sales growth significantly ahead of the homewares market. Digital sales growth of 111%, with ongoing development of digital capabilities and successful scaling of technology and operations to respond to growth in peak volumes. Growth total active customers, 4.4%, driven primarily by growth in online customers. with clear opportunities to grow customer numbers and frequency. Continued focused on health and well-being of customers and colleagues, customer perceptions of safety in the stores and via the click and collect service at 97%, gross margin up to 52%, driven mainly by sourcing gains, profit before tax of 112.4 million, which is up 34.4%, after commitment to repay the 14.5 million from the jobs retention scheme claimed in 2020, free cash flow of 98 million, resuming dividends with an interim of 12 pence a share, reflecting a strong performance from the first half and confident medium-term outlook. Chief Executive Nick Wilkinson said, "In light of another strong performance, I would like to express my sincere thanks to the whole of the Dunelm team and our committed suppliers who have continued to work tirelessly throughout these extraordinary times to ensure the highest safety standards for ourselves and our customers, and for their dedication and commitment to continuing to improve our customer proposition." Sales were particularly strong in the first quarter before we had to navigate the various restrictions which impacted the remainder of the period. These restrictions have become more severe in the second half of the financial year, with all but one of our stores currently closed, although we continue to serve our customers through our digital channels, which we have significantly advanced during the last year. Beyond the near-term uncertainty, we have never been more confident about our future. Dunelm is the market leader with a challenger brand mentality in a large growing segment. We have a clear runway to grow active customers and their frequency across our total retail system and to realise our long-term ambitions. So very positive results from Dunelm. Do you have thoughts on this retailer, Sam?
They were obviously very good. There are a couple of things in their actual presentation that I thought were worth highlighting. So the first one you've touched on, but it was their growth compared to the actual homewares market. So the market growth, excluding Dunelm, was 9.7% for the half, and that compares to Dunelm's growth of 21%. And in Q1 of the half, they actually had total sales growth of 36%, and digital sales only made up 30% of total sales. And compare that to Q2, total sales growth was 11.8%, but digital sales made up 40% of total sales. The first quarter of the first half was exceptional, and they put that down to pent-up demand. So that is quite interesting, because that does suggest, as positive as management were, it's probably not going to be sustainable. And they mentioned that under the current lockdown, they're making a modest weekly loss, but are confident they'll return to strong growth on reopening. They mentioned as well that their highest value customers make up 12% of their customer base, but 40% of their sales, which I thought was quite interesting. In terms of the shares, over the last year, they've pretty much held their own. They're up 3.14%, but over 2 years they're up 87%. Over 3 years they're up 118%, and over 5 years they're up 46%. If you look at the price to earnings for the trailing 12 months, you get 24.8, which is quite pricey. I think it seems like a quality business. They're executing quite well. The growth has been reasonable, but not amazing. So if you take the growth from 2016 to 2019, revenue's grown from 880 million to 1.1 billion, and they've got a dividend yield of about 2%. So I thought it seemed like a good business. I thought management were executing very well, but I don't think I'd pay a price to earnings of 24.8 for it. What about you, John?
Yeah, no, I think, like you say, quality business. They've obviously managed to adapt to an online model and been very successful with the click and collect. I suppose one of the things, despite it being quality, is would it be able to sustain this long term with things moving online in that sort of traditional bricks and mortar way that they are, despite adapting well, are largely based on? I think that would be the concern for me, and for any sort of retailer, and particularly a company like Dunelm.
There's a level at which, for a business of that quality that seems to be performing, that it's maybe worth paying, but I don't think a PE of almost 25 is that level.
I know. Well, yeah, okay. So then moving on to the valuation, it's it's expensive for sure, but I suppose it's quality, and depending on how long you think it would be sustainable, and if these trends continue as well. It's obviously been one of the retailers that's sort of been a lockdown winner, I suppose, alongside the supermarkets.
Yeah, Bit of trivia, but for anyone who follows the US company Fastly actually power Dunelm's website.
Very interesting. What else do we have? Coca Cola HBC?
Yes. So this is a business I've never actually looked at in any detail before. I don't think you have either, have you, John?
I think when I first came across it as a company, I was sort of reading the city section of the Times, and I think when I discovered that it wasn't actually Coca-Cola, I then moved on. But that was perhaps a little bit short-sighted, and as you're going to explain the business more now, Sam.
Yeah, that was pretty much my reaction as well initially. But yeah, so I'll just go into the breakdown of what the business is. But they basically deal with the bottling and selling of Coca-Cola products in 28 countries. So they've got the licenses to sell Coca-Cola in those 28 countries. They've split the countries they operate into 3 different markets. So they've got what they call the established markets, and those are Austria, Cyprus, Greece, Italy, Northern Ireland, Republic of Ireland, and Switzerland. And they've got a population of 91 million across their established markets in those 7 countries. They've got the developing markets, which is Croatia, the Czech Republic, Estonia, Hungary, Latvia, Lithuania, Poland, Slovakia, and Slovenia. And across those 9 countries, they've got a population of 76 million. And they've got the emerging markets, which are Armenia, Belarus, Bosnia and Herzegovina, Bulgaria, Moldova, Montenegro, Nigeria, North Macedonia, Romania, Russia, Serbia, and Ukraine. And those 12 countries have a population of 447 million. So in 2019, 53% of the sales volume came from the emerging markets, 19% from the developing markets, and 28% from the established markets. They are listed on the FTSE, and they have a secondary listing in Athens. So they were actually originally listed only in Athens, and they moved to the FTSE because they wanted better access to finance. And I think because the Greek economy was doing so poorly, they thought that was negatively impacting their credit rating. But there was quite a bit of uproar when they moved because they were the largest listed company on the Athens stock market. So yeah, so they deal with Coca-Cola sales and distribution for basically a good chunk of developed Europe, but pretty much the whole of Eastern Europe and a couple of other countries as well, such as Nigeria. Oh, and as well, and they're actually 23.2% owned by the Coca-Cola company, which is the big boy in the US. So they have come out with their full year results to 31 December 2020. In their highlights, they've said, our business adapted quickly to changing consumer behavior as a result of COVID-19 restrictions, delivering resilient financial performance, reflecting strength of brand portfolio, operational agility, and strong execution. There were improving trends in the second half of Q4 like-for-like volume down 0.7% and full year like-for-like volume down 4.6%. In 4 of their largest markets, volumes grew on a like-for-like basis, and that's Nigeria, Russia, Poland, and Ukraine. FX neutral revenue per case stabilized in the second half, improving to a 4.1% decline year over year. Full year like-for-like FX neutral revenue declined by 8.5%, while reported revenue declined by 12.7%. And they highlighted strong market share gains in 2020 with a 0.4% increase in value of share in NARTD, which stands for non-alcoholic ready-to-drinks, and 0.3% in sparkling. Performance by segment was mainly driven by each region's relative exposure to the out-of-home channels, as well as timing and severity of lockdowns throughout the year. They said they've created a more agile business, comparable earnings before interest and tax margin at 11%, which was up 0.2% year over year, or 10.6% like-for-like, which was down 0.2% year over year. Reported earnings before interest and tax declined by 7.6% to 660 million euros. The gross profit margin was up 0.2% through good management of input and supply chain costs and also FX hedging. And they said their decisive action on discretionary costs early in the pandemic delivered 120 million euros of cost savings. Comparable EPS was of 1.19 euros was down 17.5%, and that was impacted by a higher effective tax rate and a small increase in financing costs. Basic EPS declined by 14.9%. Board of Directors have proposed an ordinary dividend of 0.64 euros per share, which is a 3.2% increase year over year. Free cash flow was 497 million euros, which was up 54.4 million euros year over year. The CEO, Zoran Bogdanovic, said, "The numbers we released today demonstrate how far our business has come in building both operational agility and lasting margin resilience. I'm proud of the speed, flexibility, and care with which our people responded to the pandemic and the results we have achieved. I'm also thankful to our customers and suppliers for their valuable partnerships, which are even more critical in these challenging times. The improved second half trading was driven by a return to growth in the at-home and greater resilience in the out-of-home market. Despite a resurgence of infections in many of our markets towards the end of the year, partnering closely with the Coca Cola company team on rigorous prioritization of our joint market investments, coupled with our rapid adaptation of the route to market and excellent execution, resulted in strong value share gain in both non-alcoholic ready-to-drink and sparkling across the majority of our markets. While the economic outlook remains uncertain, we are clear on the opportunity and direction for our business and are investing to strengthen our capabilities, which will drive our long-term performance, underpinned by further advances on sustainability. Looking to 2021, we will continue adapting fast in a dynamic market and partnering with our customers to drive strong recovery and FX neutral revenues, along with a small increase in earnings before interest and tax margin. In recognition of our business strength and future opportunities, the board has proposed a dividend of 0.64 euros, a 3% increase compared to last year. We move forward with confidence and resolve to continue adapting to win. In terms of the numbers, volume was down 5.7% for the year. Net sales revenue, and these figures are all in euros, net sales revenue was down 12.7% to 6.131 billion. FX neutral net sales revenue was down 9.6% to 6.131 billion. FX neutral net sales revenue per unit case was down 4.1% to 2.87 euros. Operating expenses divided by net sales revenue was at 27.4, which was a slight drop from 27.5 last year. Comparable operating expenses divided by the net sales revenue was 27.3, and that was up from 26.9 last year. Operating profit, which is earnings before interest and tax, was down 7.6%, 660 million. The earnings before interest and tax margin was up from 10.2% to 10.8%. Net profit was down 14.9% to 414 million. Basic earnings per share down 14.9% to 1.14 euros. In terms of the performance per segment, we said that in the established segment, volumes were down 14%, with FX revenue per case broadly flat. The segment drives a larger proportion of revenues from the out-of-home channel and therefore saw the largest impact on volumes from COVID-19 related restrictions. FX neutral revenue per case performed relatively well despite lower volumes from the out-of-home channel. This was due to positive category mix driven by better performance in sparkling and stills, price increases taken at the beginning of the year, as well as positive country mix due to relatively better performance from higher revenue per case markets such as Switzerland. In the developing segment, volumes were down 4.4%, with FX neutral revenue per case down 6.2%. The segment as a whole derives a lower proportion of its revenues from the out-of-home channel compared to the established segment and benefited from good performance in Poland, the largest market in the segment. The developing segment's FX neutral revenue per case, in addition to being impacted by lower volumes from the out-of-home channel, was impacted by the strategic decision taken before the outbreak of the pandemic to take less pricing in 2020. After several years of strong price mix development in the segment, category mix was positive, driven by marginal growth in sparkling and strong growth in energy. Emerging segment volumes were down 1.8%, with FX neutral revenue per case down 3.6%. On a like-for-like basis, volumes grew by 0.3% and FX neutral revenues declined by 2.8%. The segment has benefited from volume growth in three of its largest markets, Russia, Nigeria, and Ukraine. The emerging segment's FX neutral revenue per case, in addition to being impacted by lower volumes from the out-of-home channel, was also impacted by the pricing investments implemented in Nigeria in the last quarter of 2019, as well as a negative country mix due to good volume development in lower revenue per case markets such as Nigeria and Ukraine. Category mix was positive, driven by strong growth in sparkling and energy. In terms of performance by category, so sparkling volumes grew 0.2%, with stronger performance from low and no sugar variants. Within the category, we see broad-based resilience, with trademark Coke volumes up 0.7%, Fanta volumes up 0.3%, and adult sparkling grew by 3.2%. We gained value share in sparkling and in the majority of our measured markets. Energy volumes grew by 17.9%. Monster growth volume outpaced the category, and we saw encouraging contributions from Coke Energy in the premium segment and Predator in the affordable segment. Water volumes fell by 19.7%, with similar levels of decline across all three segments. We sell proportionally more water in the out-of-home channel compared to sparkling drinks, which has been a clear driver of weaker performance. Juice volumes declined by 7.9% on a like-for-like basis. The underlying juice category in our markets has seen weaker performance in sparkling within the non-alcoholic ready-to-drink category, which has in turn impacted our performance in juice. Ready-to-drink tea volume declined by 20.2%. The underlying ready-to-drink tea category has seen the weakest performance among the non-alcoholic ready-to-drink categories in our markets. Our premium spirits volume business declined by 11.1%. The premium spirits have the highest exposure to the out-of-home channel among our categories. So in terms of valuation, trading at a PE ratio of about 20.8 over the last trailing 12 months. Dividend yield is about 2.38%. Market cap is 8.8 billion euros. Financials over the last 5 years. So these are the 2015 to 2019 figures, so don't cover the 2020 figures I just went over. From 2015 to 2019, revenue increased from 6.3 billion to 7 billion. Profit before tax increased from 357 million to 661 million. Earnings per share increased from 0.77 euros to 1.34 euros. And the dividend per share increased from 0.4 euros to 0.62 euros. So I thought these were not fantastic results, but given what's been happening in the past year, the fact that so much of the sales comes from when people are out and in restaurants and stuff like that, I think it's to be expected. I think it's encouraging that they gained market shares. I think that's all you can really reasonably expect them to do. And I think it's a particularly interesting business because of the markets in which it operates. It allows you to basically, it would allow you to potentially get exposure to Eastern Europe and those markets, which are developing, a lot of them are developing markets and very interesting markets, whilst investing in a company that you understand. Because if you were to go and look at stocks on the exchanges over there or other companies that exclusively operate in those areas, you wouldn't be able to understand it in the same way where you understand a company like Coca Cola. So to just have Coca Cola in those markets, I think is quite an interesting investment potentially. What are your thoughts, John?
Yeah, no, I think that's the last point that you mentioned is, particularly interesting, or makes this company particularly interesting. But no, I think similarly to when we discussed Diageo the other week, that actually in the circumstances, in terms of the out-of-home business, that's given how badly that's been hit by lockdowns, actually the numbers are pretty good, or certainly not as bad as you might expect. So yeah, I think it shows that it's a strong business really, and even in adverse conditions can perform relatively well. And for net revenues to only fall by 12.7%, it's pretty good really. But yeah, like you say, it's got that sort of almost that emerging markets, or certainly within Europe, theme to it, selling a quality, what you might say is defensive product. I think that probably makes it more interesting play than otherwise.
It does, yeah, because if you take it, so for example, like if you compare it to something like Unilever, which is a quality business, and we looked at it last week, Unilever, you say, oh, well, one thing that's really exciting about Unilever is this play on the emerging markets, but you've got all the rest of it. Whereas with this, it is basically just the emerging markets. And if you expect those to do well, and you expect a quality business like Coca Cola to continue to be strong in those markets and gaining market share, then I think it's really quite interesting. Definitely more than I expected before I looked at it.
Yeah. Right. So next company on the list that we've got is Heineken. So the full year results for Heineken, full year beer volumes fell 8.1% to 221.6 million hectolitres, and premium products outperformed the broader market. Heineken branded beer volumes fell just 0.4%, reflecting an 18.7% growth in the Americas, which was offset by a 23% fall in Africa, the Middle East, and Europe. Heineken 0%, their alcohol-free beer, grew by double digits in all markets, although the low and non-alcoholic portfolio still declined slightly despite beating the overall market. Underlying operating profit fell 35.6% organically to 2.4 billion euros, reflecting declines in all regions. Reported operating profit fell 78.6% to 778 million euros, thanks to 1.6 billion euro impairment and restructuring costs. Over 90% of the underlying decline occurred in Europe, Mexico, South Africa, and Indonesia. In Europe, volume in bars and restaurants fell by 40% following government restrictions, while the decline in Mexico was in the mid-teens as operations were suspended in the second quarter and heavily restricted for much of the rest of the year. South Africa was similarly affected in the second quarter and a ban on all alcohol sales in July and August, leading to volume decline in the mid-30s. Indonesian volumes declined by mid-40s, in part due to the lack of tourists in Bali. The group engaged in cost mitigation program during the year, which realized an 800 million euro saving. The program involved pausing projects such as reducing discretionary expenses and cancelling senior management bonuses. Nonetheless, underlying expenses fell just 7.2% to 17.3 billion, resulting in higher costs per hectolitre as sales shifted to lower margin channels. Heineken has reduced its workforce by around 8,000 people at a cost of 420 million euros, which is expected to generate annual savings of around 350 million euros. Capital expenditure fell from 2.1 billion last year to 1.6 billion, and free operating cash flow fell from 2.2 billion to 1.5 billion. Net debt from 15.3 billion to 14.2 billion over the course of the year due to positive operating cash flow, asset sales, and positive currency exchange movements. Heineken didn't give detailed guidance, but expects the pandemic to continue to impact the business in the first half of 2021. Revenue and operating profit expected to stay below the 2019 levels. So underlying net profit fell by 49.4% to 1.2 billion. Although Heineken made a net loss of 204 million on a reported basis. The board will recommend a dividend of 0.7 cents, which is a 58.3% decline on last year, which represents 34.9% of underlying profit. And the dividend policy is to pay out between 30 and 40% of their underlying profits each year. And on these results, the shares fell about 1.1%. In the early trading. So not great news from Heineken, unlike Coca Cola. What were your thoughts on the numbers, Sam?
I thought they were quite poor, especially compared to the Coca Cola ones we just looked at. I also thought that it was quite bad, I thought the fact they're still paying a dividend, albeit a reduced one, seems a bit silly. I don't know why they should save the money and sort the business out before they start paying a dividend, in my opinion. Because they said, as the article I'm looking at, it says that net debt's 3.4 times cash profits at the end of the year. And that's at a level that's higher than management wants it. So if that is the case, why are they paying a dividend? Why aren't they just paying down the debt?
Do you think it's a case of them seeing it as short term? I know they've said they're not expecting things to necessarily return in the first half of 2021, but they can see it out rather than cutting the dividend.
But they can just pay a higher dividend when things are back to normal if they feel that way. I just think when they've got such significant cash outflows, debt's higher than they want it to be, and they've just cut 8,000 staff, I think paying a dividend of any amount just seems a bit short-sighted. I think they should sort the business out, and then if they want to pay a larger dividend later on, then fair enough. But it's more to do with the debt than anything else. If it's above where management wants it, that's where the cash should be going to paying that off, I think.
Yeah, and I suppose it's if interest rates are so low, do you? I mean, not that they're happy to carry as much debt, but do you think that sort of makes it easier to do? And just if they're expecting things to perhaps get back to normal levels in 6 months. I mean, it's I take your point though. That would be where my view would sort of reside. But
it says the policy is to pay out 30 to 40% of net profits each year, and that's fine normally. But I think when you have such a bad year, I think you should think about just reducing it all the way to zero.
That's right, and it's interesting that Heineken, I suppose it's so reliant on selling in pubs and bars, less than, for example, Diageo that we looked at a couple of weeks ago, which did manage to maintain its numbers and had a lot of, with some of its spirits, managed to sell more of them at home. They weren't dissimilar. The Guinness sales had been hit quite badly, but I suppose Heineken, all of its brands virtually are beer, which is mostly sold in pubs and restaurants. So it didn't have any upside or anything that it could sort of fall back on.
No.
In comparison, or as much it could fall back on.
What did you think of the valuation?
It's not as cheap as you'd expect it to be.
That is based, I don't know, it says its forward price range of 25.6, but does that, I suppose it depends what they're expecting next year, doesn't it?
Yeah, and if you expect with the vaccine to have such a strong rebound, then that could sort of, I suppose, correct itself, couldn't it?
Yeah.
For where it is now, and even if you have a rosy outlook on it, it's still pretty expensive, I would have thought.
It is, yeah. I suppose profits are down 50%, but I don't know. It's not an amazing business anyway. I'd always pick a Diageo over it.
Yeah, I suppose it's the biggest in Europe, or biggest brewer in Europe, and I think it's second only to Budweiser over in the States. But yeah, it's not. I don't think it's as high quality as Diageo, and it's clearly not as resistant.
So the forward PE is actually slightly higher than Diageo's forward PE was.
Yeah, it's not one at the current price that I'd be interested in.
The 10-year forward PE is actually 18.3. Would you have been interested at 18.3 for a normal year?
Probably not.
No,
I would have thought, I could think of better businesses at cheaper prices than this one.
Yeah.
Yeah, I think the results were disappointing. There wasn't, I suppose looking forward, it's just if things do go back to normal, and if there's even more like a resurgence in people going to bars and pubs, maybe, but I struggle to see at that price that I'd want to invest in Heineken.
It said in I'll just find it, but it said in the long term as well, coronavirus has come at a time when Heineken was already reporting slower beer consumption in developed markets, a trend being driven by the twin challenges of lower consumption among younger people and aging populations. But on the other hand, alcohol consumption had been growing in emerging markets. So yeah, in the developed markets, we're drinking less anyway. So it's I guess. And going back to
Diageo on that point, they talk about the sort of premiumization of the market. So while people are drinking less, they're going for the higher margin, more expensive brands, basically. So they're
still sense.
It does. But I suppose if it's a product like beer, you can't do that so much.
No, you can't. Yeah, it doesn't look rosy, I don't think, for it.
No,
it could do fine. I just struggle to see it doing really well.
Yeah, no, that's it. Okay. Well, that's it for the British/European companies. Next is our US stock of the week, which is Disney.
Disney, yeah, back again. So Disney have reported their Q1 results to the 2nd of Jan 21. So last time we looked at Disney on the show, they'd reported their full year 2020 results, and they had revenues down by 6%, and Disney Plus had 74 million subscribers, and operating profits were down 45% for the year. So For Disney's most recent quarter, their first quarter revenues were down 22% to 16.2 billion, which was marginally better than analysts expected. That reflected significant progress in the direct-to-consumer business, which was offset by continued disruption to the theme parks. Operating profit fell 67% to 1.3 billion as the parks moved into a significant loss. Whilst restructuring and accounting charges relating to the 21st Century Fox deal meant reported profits fell 99% to 29 million. Despite this, operating profits were significantly ahead of expectations. For the media and entertainment distribution side of the business, revenues fell 5% to 12.7 billion. All these figures are in dollars, by the way. As the group saw cinema and home video sales fall 56%. That was offset by a 73% increase in direct-to-consumer sales, which are now at 3.5 billion. Disney Plus subscribers more than tripled compared to a year ago to 94.9 million. And ESPN Plus subscribers rose 83% to 12.1 million. And Hulu subscribers rose 30% to 39.4 million. Operating profits in the division fell 2% to 1.5 billion, as lower profits in networks and content were offset by lowered losses in direct-to-consumer. Notably, linear networks, which includes the likes of ABC, ESPN and Star, and accounts for 7.7 billion of revenue, reported a 2% rise in revenues and just a 4% decline in operating profit. That reflected increased political advertising and a shift in IPL games on the revenue side, while the increased cost of college football playoff, NBA and IPL content impacted margins. Parks, experiences and products remained quite negative, with sales down 53% as parks and cruise liners remained closed or operating at reduced capacity. Operating profits in the division fell from 2.5 billion a year ago to a $119 million loss, despite a modest uptick in consumer goods sales. The group reported a free cash outflow in the quarter of 685 million, compared with 292 million inflow last year. Net debt of 41.2 billion represents a modest increase on the 40.7 billion reported last year. In terms of the valuation, it's currently trading at a PE ratio of 74.6. However, that's distorted by the fact that the earnings are down so much. 10-year average PE ratio is 19.7, and the prospective dividend yield for the next 12 months is 0.6%. One interesting thing is that if you include ESPN Plus, Hulu and Disney Plus all together, they're now approaching 150 million subscribers, which is 75% of Netflix's current total.
For the just purely for the streaming platform, Disney Plus is 94.9.
Yeah, which even last time we talked about it was only a few months ago, and it was only at 74 then. So
yes, yeah.
Crazy. So overall, the streaming business is loss-making, but these losses are narrowing. There's a few tweets actually that I wanted to read out. So Rich Greenfield at Lightshed, he said that it was important to realize that average revenue per user on the streaming side was actually down. So in the fourth quarter 2020, average revenue per user was $4.52 per month, and that's now down to $4.03 per month. And in Q1 2020, it was actually at $5.56 per month. I can't say that concerns me particularly, because I think they need to get as many users as they can, and then they can slowly increase the price over time. And I do think people will pay for it. Charlie Bilello said at its launch, Disney was projecting 60 to 90 million Disney Plus subscribers by 2024. We've already surpassed those estimates with 94.9 million subscribers at year end, a 258% increase in the prior year. Quoth the Raven said, Netflix trades at 10 times sales. Disney at 10 times sales would be $380 per share. It's currently about 190, by the way. So yeah, I thought that was interesting. I think the only real negative was, I don't know if it is really that much of a negative, but I guess the $71 billion acquisition of 21st Century Fox meant they had to take on a significant amount of debt, and interest costs were 52% higher than last year, and that's got to be paid regardless of the level of profits. However, that level, the total debt isn't really changing, so I don't have any issues if they can just tread water for a while, and then once everything comes back to normal, then I don't think they're going to have any issues with that debt. So in terms of the actual valuation of the business, the share price is currently $187. and the market cap is 344 billion. John, thoughts on Disney, and as a shareholder, how do you feel about that quarter?
Well, I think it's exciting, the growth in Disney Plus and the online streaming platforms. Like you alluded to, I think I'm confident that the park business will return, and it's probably maybe the first half of 2021 it's not going to, but the second half and going forward, I'd be very optimistic for it. And like you say, if you compare it with other US companies and Netflix in particular, Disney doesn't look that expensive.
Looks cheap, I'd say. I'd go that far.
I don't know whether it looks cheap, but it doesn't look expensive. And for getting such a quality business with this new sort of growth element to it, it's very appealing. And they're coming up. I know The Mandalorian, they had a lot of success with that, but they're producing more online TV shows. The other thing that's interesting is when cinemas return as well, that side of things, and bringing in more revenue from that, which has obviously been hit quite a lot. And Mulan had to go straight to the online streaming rather than going to the box office as had been planned. But no, I'm a backer of Disney and very optimistic about the next few years ahead.
No, I thought it was really, like, you know what most of the business is going to be doing whilst it's shut down. So I think what's really important to focus on is, firstly, is the long-term position getting worse? So is the debt getting, what's the free cash outflow and stuff like that? And that's all manageable. And then also Disney Plus, and the Disney Plus numbers are staggering. They really are, considering, I think they set a target of 240 million by 2024, and they've now just gone and raised that. And it looks like they're going to hit it. And it really is an amazing business. When we talked about it last time, actually, I said that next time we talk about it, I suspected I'd be a shareholder by then.
And are you?
I'm not. If you look at what the share price has done.
Yeah, it's done well.
I wish I had been.
Yeah, that's it in terms of the companies for this week. Out of the companies we've discussed, Sam, what would be your pick of the week?
I think it's an unfair question this week, because there are very, very few businesses for me where if you put them up against Disney, they're going to win. So it would be Disney, just because it is such an awesome business. I don't know why I don't own it. I'm completely in love with it. I think it's an amazing business. But I did really like Coca Cola HBC.
Yeah, no, that's the one that, Disney aside, I think that does stand out and is a bit more. Well, it's interesting, I think, especially in the markets that it operates in, which I hadn't appreciated before you sort of read up on it this week.
No, I'd never looked at it.
That's maybe one that would, out of them, go onto the watch list.
I read a book on Walt Disney recently, actually.
Oh yeah,
it's by a guy called I think it's Stephen Watts. It's a different Stephen Watts than the one who wrote Ready Player One. But it's called Walt Disney and the American Way of Life. But that's very good. And you'd probably come away from it appreciating the business even more, because even in the early days, they were always at the forefront. You don't think about it now, but when Snow White came out, no one had seen anything like it. Like, no one had seen a cartoon that length. It's like a full feature film. It's really, really, really interesting history. And because Walt and Disney at that stage, the histories were basically one and the same. If anyone's interested, it's called Walt Disney and the American Way of Life.
Okay, fantastic. Well, I think we'll probably end on that note, and we'll see you next time.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter @TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.